Most people will work until they are 65, retire with barely enough, and spend their final years hoping the money lasts. That is not bad luck. That is what happens when your only income is your job. Passive income changes the equation. It means money coming in whether you work or not, from investments, from content, from assets you build once and get paid for repeatedly. In the next 10 minutes, you will see exactly how people in the USA, UK, Canada, Australia and India are building real passive income streams in 2026, and how you can start today, even if you have very little money right now. Before we look at the strategies, let us be honest about what passive income is not. It is not a get-rich-quick scheme. It is not waking up to thousands of dollars overnight with zero effort. Every passive income stream requires either money upfront, time upfront, or both. The difference is that once it is built, it keeps paying you. Think of it like a machine. You spend time or money building the machine. Then the machine runs on its own. That is the goal, and every strategy in this video follows that same principle. Strategy 1: Dividend investing. You buy shares in companies that pay dividends, and those companies send you a portion of their profits every quarter, without you doing anything. In the USA, the S&P 500 average dividend yield is around 1.3 to 1.5%, but individual dividend stocks like Realty Income or Johnson & Johnson regularly pay 3 to 5%. In the UK, the FTSE 100 historically yields around 3.5 to 4%. In Australia, franked dividends come with tax credits attached, making them even more valuable for Australian investors. In Canada, the TFSA lets you collect dividends completely tax-free. In India, platforms like Grow and Zerodha give you access to dividend-paying stocks and mutual funds with no minimum investment. Strategy 2: Index funds and ETFs on autopilot. This is the most beginner-friendly passive income strategy that exists. You invest regularly into a broad index fund, something like a total market ETF, and over time, you collect dividends and benefit from compound growth. You do not pick stocks. You do not watch charts. You set up an automatic transfer on payday and let it run. In the USA, funds like VTI and SCHD are popular choices. In the UK, the Vanguard FTSE All-World ETF is widely used. In Australia, the Vanguard Diversified ETF range is popular inside superannuation. In Canada, XEQT and VEQT are common choices. In India, Nifty 50 index funds through a monthly SIP on iEnd Money or Grow give you broad market exposure with as little as 500 rupees. Strategy 3: High-yield savings accounts and fixed-term deposits. This one requires the least effort of anything on this list. You move your cash from a standard bank account into a high-yield account, and you earn interest automatically. In 2026, rates have come down from their 2023 peaks, but competitive accounts still offer meaningful returns. In the USA, Marcus by Goldman Sachs and Ally Bank are paying competitive rates on savings. In the UK, easy access savings accounts through Marcus and Chase UK have offered strong rates. In Australia, ING and UBank have competitive savings rates. In Canada, EQ Bank is well known for high-yield savings. In India, small finance banks like AU Small Finance Bank and Ujjivan are offering fixed deposit rates of 7 to 9%, which is significantly above standard bank rates. Strategy 4: Rental income from property. This is the traditional passive income strategy most people think of first. You buy a property, rent it out, and collect monthly income. In the USA, residential rental yields vary widely, from around 4% in expensive cities to 8% or higher in smaller markets. In the UK, buy-to-let yields average around 5 to 6% outside London. In Australia, gross rental yields in Brisbane and Adelaide have been above 5% recently. In Canada, rental income is taxable but deductible expenses can offset the bill significantly. In India, residential rental yields are typically low at 2 to 3%, but commercial property yields of 6 to 8% make it more attractive for investors with larger capital. The catch with property? High entry cost, and it is not truly passive. You are a landlord. Strategy 5, Real Estate Investment Trusts, or REITs. If you want property income without the cost or headache of being a landlord, REITs are the answer. A REIT is a company that owns income-producing real estate, shopping centers, hospitals, data centers, warehouses, and by law must distribute at least 90% of its taxable income to shareholders as dividends. In the USA, REITs like Realty Income, Vici Properties, and Prologis are popular. In the UK, REIT dividends are paid as property income distributions. In Australia, listed property trusts work similarly and are available through the ASX. In Canada, REITs are widely held inside TFSAs for tax-free income. In India, Embassy REIT and Mindspace REIT are listed on the NSE and BSE and offer exposure to commercial real estate. Strategy 6, Creating Digital Products. This is the zero physical inventory passive income model. You create something once, an ebook, a template, a Notion dashboard, a Lightroom preset pack, an online course, and sell it repeatedly with no additional effort per sale. Platforms like Gumroad, Teachable, Etsy, and Udemy handle the delivery and payment processing. The upfront effort is real, creating a quality product takes time. But once it exists, every sale is pure margin. A single well-made spreadsheet template on Etsy has been known to generate thousands of dollars over time with no ongoing work. The key principle: solve a specific problem for a specific audience. Vague products do not sell. Precise products do. Strategy 7, Affiliate Marketing and Content Creation. If you have a blog, a YouTube channel, a podcast, or even a newsletter, you can earn commission by recommending products and services your audience actually needs. You do not create the product. You do not handle customer service. You simply refer people, and when they buy, you earn a percentage. Commission rates vary. Amazon Associates pays 1 to 10% depending on category, but software affiliate programs often pay 20 to 40% recurring commission. The key is that your content keeps working after you publish it. A YouTube video you made 2 years ago can still be driving affiliate clicks today. In India, platforms like vCommission and QLinks connect creators with Indian brands across insurance, fintech, and e-commerce. Strategy 8, Peer-to-peer lending and bonds. This is lending your money to individuals or businesses in exchange for interest payments. In the USA, platforms like Lending Club have offered this model for years. In the UK, platforms such as Funding Circle and Zopa have operated in this space, though UK regulation tightened significantly after 2020. In Australia, peer-to-peer lending platforms operate under ASIC licensing. In India, RBI-regulated P2P lending platforms like Faircent and Liquiloans allow investors to lend to verified borrowers. The risk is higher than savings accounts or index funds. Borrower defaults can reduce returns, so this strategy suits investors who understand and accept that risk. Government bonds are the safer alternative in this category, offering guaranteed but lower returns. So which strategy should you start with? The honest answer depends on where you are right now. If you have money but not much time, dividend stocks, index funds, REITs, and high-yield savings are your fastest path. If you have time but not much money, digital products and content with affiliate marketing are built on sweat equity, not capital. If you have both, combining a long-term index fund portfolio with a side income stream from digital products or content is the most powerful combination. The biggest mistake people make is waiting until they have more money, more time, or more confidence. The best passive income stream you can build is the one you actually start. Here is what a realistic passive income timeline looks like. Month 1 to 6, you are building, planting, and seeing nothing yet. Month 6 to 12, small returns start appearing. Year 2 to 3, compounding and consistency begin to show real results. Year 5 and beyond, your passive income may be covering a meaningful portion of your expenses. This is not a sprint. The people who succeed are the ones who treat passive income as a long game and keep adding to it consistently, even when early results feel small. Every dividend reinvested, every extra sale, every content piece published is compounding in your favor. 3 rules before you start. Rule 1. Never invest money you cannot afford to leave invested for at least 3 to 5 years. Rule 2. Diversify across at least 2 or 3 different passive income streams. Relying on one is a single point of failure. Rule 3. Track your passive income separately from your salary every single month. Seeing it grow, even slowly, is one of the most motivating things you can do. Start a simple spreadsheet. Every dollar, pound, dollar, or rupee of passive income you earn gets recorded. Watch that number grow month by month and it will keep you going. Your action step for this week: pick one strategy from this video and take one concrete step toward it. Open a brokerage account. Set up a monthly SIP. List your first digital product. Write the first article. One step. Not 10. 1. The gap between people who build passive income and people who just talk about it is not knowledge, it is the first action. Take yours this week. If this video helped you, subscribe for more personal finance content every day. Drop a comment telling me which passive income stream you are starting with. I read every one.